4th. I'm delighted today to be joined by Omar Najia, head of global derivatives at BB Energy, and Maliha Bengali, founder of MB Commodity Corner, sitting nicely, not with a nice background, looks like it's outdoors, and Ian Nathan, director of global energy research at Energy Intelligence. Thanks so much, everybody, for joining us. Maliha, let me start with you this morning. We had an expected announcement, I suppose, if you can let me know if you agree with me, that OPEC will be extending these cuts through to June. There was some concern last week about the nature of how this would come out, because individual countries get to sort of announce when they want to, but they seem to have come together and sort of preempted that, more or less. What do you expect to be the impact, if at all, on oil and oil prices?
Thank you, dear. Thank you for having us on. In terms of the announcement, we don't think it's a surprise at all. I think the oil prices have been very stable around $82 to $83 a barrel Brent. OPEC Plus is pretty pleased with what happened so far. We have to take a step back and realize that these cuts were put in place just for 1 or 2 months last year. Oil prices rallied, but they didn't really take off as OPEC expected demand to pick up.
Yeah, nice tie, Ryder Schumann.
But the Q4 demand has been pushed back to Q1, and I think now probably Q2. So they're quite aware of that. And I think they did the right thing by just keeping things as is, hoping that a recovery later in the year will take prices higher. But in the end of the day, they don't need to change anything right now, as seems to be holding in. So it's not really a surprise, and the market expected that.
Okay, Omar, but let me go to you on that again. The market expected it because it's required, I suppose, if they want to keep prices here. Do you think it'll be enough to hold? Does it matter? And will it be enough to hold that Brent price above 80 for the next 3-4 months, Omar?
Yeah. Do I think that Brent? I think the market's going up. I don't think what OPEC does and doesn't do in OPEC Plus. So basically, they want to maximize revenue. So it'd be really shocking to me if they started to increase production and put it on the market, right? So basically, they're telling you that the world is black. And yes, I would be shocked if they came out in the next meeting and said the world is white. So yes, but I don't believe that that's going to be basically a big driver for the market, because I don't really think that anybody expects them to come out and say that the world is actually white. So yes, OPEC and OPEC Plus will continue to support the market. And I think basically that this market is going to go higher, and considerably so.
Okay, thanks, Omar. Ian, good morning and welcome. Let's talk a bit about LNG. That is a market that looks like it needs a little bit of support, doesn't it? And prices are looking pretty somber there. Obviously, a reflection of global demand, or is it more of a cyclical expectation?
Well, yeah, and it's interesting because we've been talking to clients about how really what we see now is actually very much a replication of what we had seen last year, which is ample European storage, really weighing on the market as with visibility toward the end of the winter. So we'd expected that prices were going to be pretty weak, in the first quarter and heading into the second quarter. I think what's really interesting now is that now that we have really good visibility on the next LNG supply wave, starting later this year and definitely into 2025. I guess the real issue is, does this weakness remain? And really just watching out for any sort of volatility that may happen during the course of the year. Again, that was something we saw last year, several different instances of volatility that caused some temporary spikes. But ultimately, a weak market really outweighed everything else and continued to pull prices back down.
And I mean, Europe, as you said, is well supplied and well stocked, and it's had a warmish winter, etc. What about Asia? We have 1 or 2 headlines today on our bulletin as well that are sort of mentioning Chinese spot LNG demand. Again, is it, and would you expect China to take advantage of these low prices if it can, given obviously the economic scenario there as well?
Well, sure. I mean, with China, I mean, we could probably spend a separate hour on China alone. And clearly there are a lot of headwinds there, to Chinese demand. But with prices at levels where they currently are, I mean, we do see opportunity for Chinese buyers to come back in into spot buying, as we would with other price-sensitive buyers as well. At the same time, any likely impact of a Chinese return to spot buying probably has a bit of a ceiling, because if prices then rise above, let's say $10 or so per million BTU, we'll probably see that start to fall off again. So certainly some demand response to lower prices is definitely expected. And so I think the key issue here is that, or the key question is whether or not any of this, any rebound is enough to really support prices in Asia. And that's something that remains difficult, particularly while other big buyers are showing some weakness. So, it looks like a bit of a mixed bag for now.
Yeah, and as you said, medium term, plenty of supply coming on, and those announcements also from Qatar and US just last week that they're planning to even increase that. Maliha, let's talk a little bit about the US monetary policy expectations. We've got a bit of a big week this week. Got, I think, Chairman Powell speaking in front of somewhere, some committee or some not announcement, but he'll be talking and giving the markets further indications of what's to come. We've got the ECB also on Thursday. So, I mean, where we stand, and stock market keeps rallying. US economy is looking pretty healthy. Are we going to see a slight shift in the expectation on interest rates drops, if you like, for the year ahead or for the months ahead?
That's an excellent question. Back end of last year, Powell actually surprised the market by announcing 3 rate cuts and became surprisingly dovish when the market was looking a bit sort of dicey. But he's actually got on the back foot right now, because the US Fed actually has preempted 3 rate cuts. The market, as you know, was pricing 6 to 7 cuts, and over the course of the last 2 months has been repricing it lower. The financial conditions have eased massively. The US data has been very strong. There is no need to cut, but the Fed has this dual mandate of price stability and maximum employment. And obviously, inflation's been coming down, but it really hasn't been coming to the 2% level. The trajectory is right, but the last few data has been showing a resurgence, a pickup in the core PCE data. So they really haven't won the battle, and the Fed's been very clear about how they're going to maintain the level of rates until the data is consistently and sustainably at their target. So I think the big dilemma in March is going to be a very important month for the macro markets. I know people say macro is dead, but really is never dead until something happens. I think the FMC will be interesting because they need to walk back these rate cuts. The longer they keep this sort of dovish tailwind in the market's getting very, very sort of loose and, getting to new highs. And they don't want the inflation picking up again, because that's a genie back in the bottle. So you are right. There might be some tapering back. Fed speakers might be a bit hawkish this week rather than dovish. The dollar might be at risk of rallying. The data doesn't support cuts, but the banking market is very different. That banking crisis is still evident, and they need the rate cuts. So the Powell is in a bit of a catch-22. Save the banking or save, the consumer. So we'll see what happens, but we think that they need to be a bit more hawkish than dovish going forward. And the rate cuts actually have a lag effect, but employment data is showing signs of weakening. It takes time, 8 to 12 to 15 months. So as much as it's calling a victory, we don't think it's really, the whole market's been going through recession. The US is taking a bit of time due to the fiscal spend. So we are quite patient and seeing that data catch up.
Yeah, it is that fiscal spend that's keeping everything elevated, isn't it? And without it, it would be interesting to see what would happen. And I mean, Ian, I'll just go to you for just a general sort of take from you on US economy, and not necessarily on LNG, but just, again, the sentiment that you get there. And we've had corporate earnings results, which have been looking really good and much better than expected for Q4. But a lot of analysts are saying, yes, we can look at the big 7 and they're still, sort of hurling ahead, if you like, on the stock market. But SMEs are feeling the pinch. There's debt, there's high interest rates, there's, so is that, do you feel, Ian, do you get the sense that that's going to start kicking in a bit more, even if we don't get a hard landing, that we are going to see some impact on the US economy from corporate, I suppose, performance as we go into the year, further into the year?
Yeah, I mean, I think, I think a lot of this comes back to what we were just talking about here with, with the sort of speed and depth of rate cuts. I just recall that, as toward the end of last year, I think the expectation for, I guess among industry players were you know, they were going to be more frequent and sooner rate cuts was something that was fueling a lot of the sentiment, and I think that is you know, clearly weakened somewhat. You know, and the expectation now that you know, this can take a little bit longer, and there, I think, growing questions about how deep any cuts might be when they do arrive, perhaps later this year, is something that I think is worth watching out for, particularly with regard to performance in some of these you know, in some of them in some of these market names, some of these stocks, for instance. So I think that's really a key issue here, worth watching.
Okay, thanks, Ian. Omar, let's get your take on whether you think, and I know you're probably going to say no, because that's your general opinion on this, but, you know, Russian oil revenue sanctions, etc., which have, yes, for all intents and purposes, kept Russian oil flowing. But there have been a few headlines the last week or two that Russia is beginning to feel the pinch of that, and you know, may or may not be taking advantage of the sort of discount games that it's been playing, just simply because of domestic reasons, you know. Would any indication there in terms of what's happening on the refined product side in Russia domestically, and then what's it exporting, and how that might be impacting international flows?
Okay, so basically, I think all you need to look at is the EU have come up, I think, last week or the week before with the 13th round of sanctions. If sanctions were working, it wouldn't take 13 rounds of sanctions. So sanctions are not working at all. You can forget about it. There's nobody talks about $60 Brent cap and I don't know what. Nobody cares. It's finished. It's done. It's dusted. Has zero impact. The only thing that you're seeing is basically Russia sells its distillates to North Africa, to India, to whoever. It gets re-exported to the EU, which is why, you know, EU economies and manufacturing are collapsing, because they're no longer competitive, which is why you're going to see a lot of these governments change and lose, you know, including Germany, including France, including Little Rishi in the UK and all this kind of stuff. So it's a complete disaster. It's I mean, wherever you look at the idea that West is basically going to continue on being the, you know, number one leader in the world, it's in total collapse. You look at Ukraine, you look at Palestine, you look at basically the BRICS, you look at oil, you look at sanctions, you look at the dollar, you look at all of that. It's an unmitigated total disaster. Then you look at the leaders who are supposed to, you know, take everything forwards from here. You've got Joe Biden and his ice cream. You've got Rishi Sunak, who's unelected. You've got Macron, who's basically hated. You've got Schultz, who's got no clue what he's doing, always looks lost. So wherever you look, from top to bottom, economically, whatever, it's a complete and utter disaster. So okay. Yeah.
Yeah, I know. I mean, it is getting worse. I agree, Omar. But let's just staying with you, just on sort of demand, etc. We have a headline, and I want to talk about it because you have a little jet oil sign in your backdrop there, and it triggered this article that we have about Indian jet fuel demand soaring. Any significance there? I mean, is that expected? Do you see a pull of jet fuel into that country more than usual, or was that something? And is it impacting other flows?
Look, I mean, you know, if you look at jet compared to gasoline or distillates, it's small. So, but everybody wants to talk about it because everybody wants to say, yeah, people will be flying more in China. But, you know, I've been hearing the same stuff now for 2 years plus. It's going now, people are going to travel, I don't know what, jet. All I can say is from my experience of, you know, getting on board planes, every plane is full, everybody's traveling multiple times a year. So no, I don't expect it to change. So I don't. You also have to understand that in general, the West and the mainstream media want you to believe that the East is collapsing and their demand is like terrible and their economies are terrible and they're all autocratic and all this kind of stuff because they have an interest in lowering basically oil prices. So, I don't spend a lot of time reading the news, to be honest. No.
Okay, thanks, Omar. Maliha, just back to you. Let's talk a bit about, again, OPEC again, but more specifically Saudi. You know, we saw it in recent months dropping its OSPs into Asia to remain competitive, make sure that, you know, it's competing with non-OPEC oil, etc., as they were trying to support the market as well at the same time. Are they a bit more relaxed now, do you think, about that? There was signals that they may be sort of keeping prices the same as we go forward. And as we approach, of course, after this move, yesterday announcement, and as we approach the June meeting on quotas, I mean, where do you think the Saudi thinking is today on that?
I think they're definitely relieved the prices are staying where they are. To be honest with you, I think market share is a big issue for them. They may not say it, perhaps I have not heard it, but in the back of their minds, we're in a very different price cycle right now. They have a lot of investment invested on this oil price trajectory. And I think you can see the reaction from 2020 or 2018 to today. You know, they've been quite relieved, and they can't afford a price war because they can't afford prices to get out of control. But market share is an issue for them. US shale has been so strong, 13.3 million barrels per day. And we're seeing all that sort of demand coming from as Omar mentioned, those Russian barrels are making it to the market. So the end consumer demand is fighting for those barrels. So Saudi is keeping prices flat as prices have been flat, but they are still quite expensive compared to other prices. And until we see a growth fall off in US shale or the sources of oil, the question really is not on supply, it's on demand. I mean, they've done a great job in keeping supply out of the market, but let's not forget, we have a lot of oil on the sidelines. So if we get a demand resurgence from China or other parts of the market, or even EU, that is the key call for the second half of this year. And if we get that, of course, prices rally and they'll be very happy because they'll meet all their budget considerations. But what if, and nobody's asking this, what if we have a recession? There's less than a 0% chance of that being priced in today versus 90% last year. And that's something no one's even talking about. And what will OPEC do? What will Saudi Arabia do? Great questions. You know, we don't know.
Yeah. People getting maybe a bit complacent and more comfortable about that. That's not going to happen. Ian, what about the US export move on LNG? Give us your take on that. Biden sort of a few weeks ago saying, oh, we're going to, slow those down or, you know, I mean, that sounds like a temporary political play, but give us your analysis of what you expect and how long you expect that to remain the case.
Yeah, I mean, I think that's that's pretty much it. I think you have to view that this temporary pause, whatever you'd like to call it, really through the lens of a critical election year, for this president. And look, this pause was really the minimum that is needed to really keep certain elements of the Democratic Party from souring on Biden in a year where he really needs them to turn out in November. And I think that's I don't think there's any really getting around that. But in terms of impact, I mean, we got to remember that you still have 79 million tons a year of capacity already under construction, and so if we're talking about any impact, it's going to be down the road. And that is for, I guess, several ventures that we had expected to reach FID this year that are now caught in the regulatory net. If it's a year of a pause and things, get back on track a year from now or so, that's one thing. If in fact the Department of Energy and the Biden administration really review and revamp criteria for non-FTA licensing, in a way that hits these projects, and we're talking about a more severe impact in terms of supply in the coming years. I think there's also potentially a silver lining here, believe it or not. So for all the outrage and upheaval and all of the questions, I'd like to think that a year from now we might have probably a better idea of what some of those regulatory criteria might be. It's not certain, but I'd also add that certainly on the climate and emissions part of the criteria that are being reevaluated, I'd like to think that the projects under development are already moving in that direction to reduce their carbon footprints, and so at least this is something that's already in motion. Although some of the other criteria that might be under consideration, which include Henry Hub price impact or other issues with regard to perhaps local communities, et cetera, are a little bit more uncertain. But still, clearly this is disruptive, and I think what we're watching right now very carefully is to see if this ultimately spooks buyers from from committing to U.S. projects, or spooks buyers that have already committed to U.S. projects, that ultimately slow them from development even after the regulatory pause is over. So that's our focus. Okay,
great. Thanks, Ian. There's our question for today about OPEC. Will the decision that they've just taken be enough to support Brent above $80 for the next few months, basically? Is that going to be the clinching point that's going to do that or not? Yes or no? Omar, let me go to you. It's been a week since we last spoke to you. Do you feel any difference in how the market's feeling about the shipping activity in the Red Sea, the skirmishes there, another couple of vessels attacked, one I think sank in the last week? I mean, where's that escalation, if you like, going from a market perspective? It certainly doesn't seem to be reflecting the price much yet.
Well, yeah, I mean, I wish it was that easy. I wish I could just read the news and then go, oh, this is bullish buy, and then read the news and this is bearish sell. So no. So the stuff, like I said last week, the stuff about the Red Sea is impacting distillates and distillate premiums in terms of shipping times, in terms of a lot of other stuff, right? So you're not going to see it reflected in the price because supply is there. It's only a question of delays and this kind of stuff. So that means basically like spreads will be affected much more than flat price. You've got to put that aside. You've got to look at the market. You've got to trade the market that's in front of you. Everything can happen. You could have an alien invasion in a month, or Biden could, transition, in June or something. So who knows? You've got to trade the markets in front of you. Markets in front of you are bullish. How do we know? Equity markets in the US are setting all-time new highs. Spending in the US in terms of budget is at never before seen highs. We have an election coming. We have wars. Bitcoin, which is a representative of risk on premium, is very close to setting new highs. It's already set new highs in multiple currencies. So it beggars belief. I mean, I like it when people want to, sell and yes and no, but this market is bullish. This market is going higher. It is not the only one. It is basically the effect you're seeing everywhere. You have basically the 7 stocks in the US, which will go higher still, and that's an indication of fear. It is not an indication of people saying, return of investment or whatever they look at, price to earnings and all that kind of stuff. No. It's basically people don't have anywhere else to put their money if they want to invest in equity. So they buy those 7 stocks. It's that simple. The market is inflationary. They will cut rates because they have no alternative. If they raise rates, which they should, but they won't. And why? Because their debt is absolutely massive. The issuance that's to come in terms of debt, not only from the US, but also for Europe. The EU wants to issue like European debt to help pay for Ukraine. So inflationary higher. The only thing you do when your debt is massive is you inflate. If Biden stays as president, he is going to cut rates. If Trump comes in, he is going to cut rates. The only people that don't want rate cuts basically are the US banks. And we see what happens. I actually happen to agree with what they want, but let's see. But I think the markets are inflationary, they're bullish, and it's not just oil, it's across the board. And LNG or Henry Hub at all-time lows, blah, blah, blah. I mean, honestly, seriously. I don't care what they say about, supply and new ventures. I don't know what. I would just buy it with my eyes closed. I really would.
Okay. Thanks, Omar. I'll take that tip. Maliha, I mean, let's talk about the debt. Obviously, that's there. Nothing has changed, and the US debt and how that's going to influence, obviously, monetary policy. I mean, it's a never-ending kicking the can down the road, isn't it? I mean, we're not really going to see any shift there, are we?
You're absolutely right. We obviously increased debt by $240 billion in a couple of days. Every day we see a higher number. We are now close to $35 trillion. There is no end in sight. And, Umar made some really good points. The US has no choice but to eventually cut rates because the interest expense is too big. But let's take a step back a bit. It's interesting when we talk about bull markets because the market is only in the S&P is a bull market because of those 8 stocks. Take a look at the Russell, the small cap, the mid cap. Take a look at all the stocks. They're down. We're actually not in a bull market. And when you look at stuff like, Bitcoin, there's a very specific event why it's rallying because of its halving event. There's a massive ETF inflows. I mean, they're preempting some rate cuts, but I don't think we really are in a bull market. There's some very stock specific factors. Nvidia, AMD are rallying, and they probably will continue to do so because there's a massive earnings growth story. So they're very sort of specific catalysts, but to categorize all of that, say we're in a bull market, it's a bit sort of preemptive. But I do think, yes, if the market really was that strong, we'll be up. Commodities are not rallying the first quarter this year because Chinese demand, EU demand, the whole world is slowing down. Only US is high. At some point, this is an election year, so very anomalous. They'll probably keep it higher for longer. But eventually, it's inevitable for the rest of the world to catch up to the US because something needs to happen. So I'm taking a step back by saying that I don't see the rest of the world picking up. I see US slowing down effectively, right? So that's my philosophy. If not, we should have rallied all the commodities. Copper has not moved.
Yeah,
since
those base metals are very low.
That demand? Where is that demand that we're talking about? There is serious recession in the global economy. US consumers maxed out. Credit card delinquencies, auto delinquencies. I can give you 1,000 charts. So there's a very pocket of strength, like small pockets of strength. And I think that's where the Fed sort of had a dilemma. Do we sort of get that to go higher today with rates and where they are at market at all-time highs? Or risk inflation going back to 5%. So we need to be very careful. And that sort of reflects, what's going to happen to commodities going forward.
Yeah, they have to be very careful about that. That inflation is still lingering, isn't it? Ian, let's go to you. I just want to talk to you a bit about Japan and LNG, because of course, that has been a very significant consumer for a long time, and it's had its ups and downs. But where's the trajectory there, do you think, in terms of their planning for LNG spot cargoes in the coming months? There's some positive signs on the Japanese economy, relatively speaking, to not just the stock market, but generally, there's some changes there on policy. So any outlook there for the LNG market specifically? Does it care?
Well, I think, last year we were watching carefully to see how fairly significant, Japanese LNG stocks were going to impact the market, because after a particularly tough summer, those stocks were depleted. And, we were watching carefully to see if, in fact, the restocking was going to be impactful in the market. And it turns out did not turn out to be that way. So we have adequate stocks in Japan right now. And I think really, at least from our point of view, really the big issue, and I think the big issue for everybody who watches this market is, continues to be, the rate at which nuclear reactors will continue to start up. I mean, because this is really what is taking chunks of LNG requirements, out of the picture. And there's been some success with solar and and that sort of thing in Japan, but ultimately this is how we're really looking at those requirements. So so we'll continue to watch that carefully. And when you look at Japan, when you take a step out and look at it, we're really in terms of LNG requirements, we're just looking at various types of a downward slope in terms of those requirements. So if in fact those restarts are slower than anticipated, the decline of LNG requirements will also slow down somewhat. So that's our view.
Okay, Ian, and just to stay with you, just on the Russia gas supply issue. I mean, Europe has adjusted, obviously, to an extent. It's got plenty of stock at the moment of gas. The LNG infrastructure also is being invested in. Do you see that as something permanent now? I mean, some people are saying Europe will, eventually, once this Ukraine-Russia war is over, we will turn back to some Russian pipeline gas. What's your opinion on that in terms of how it's impacting LNG market thinking?
Yeah, it's still a key question, and this dominated a lot of the industry conversation in 2022 and in 2023. Where if you ask two different people, you're going to get two different answers. One person would say, in fact, European buyers can't wait to get back to inexpensive Russian pipeline gas, and the other half saying they can't even imagine a scenario where it's even practical or politically expedient or even even realistic to have a return to normal, quote unquote normal, whatever that might be. but I think the conversation's evolved somewhat. I think, you know, what we've found, certainly toward the end of last year, is that the bigger question, I think, is how any incremental Russian gas supply volumes, how that might alter the market more broadly, you know, globally. So whether or not additional or increased volumes return to Europe at some point, whenever that might be, also need to be considered against, you know, the much longer term with increased pipeline volumes to China, particularly after 2030 with the Para-Siberia 2 pipeline, perhaps, you know, and really the expectation that additional Russian gas back into the market, you know, is a significant displacement vehicle for LNG elsewhere. That is where the conversation has been heading recently. And so that's really worth considering, I think, and moving on, I think, from the you know, the European gas future, particularly as Europe makes strides in eroding and perhaps destroying gas demand and you know, and finding alternatives. So you know, as we move on year after year, that Russia question, I think, becomes a little bit less relevant as Europe makes strides in this direction.
Okay, thanks so much for that, Ian. We've run out of time, ladies and gentlemen. Thanks so much. There's our result. 63%, yes, think it will be enough to hold prices above $80 at least for the next few months. So let's see what happens. We had everyone saying in March we'd see more or less same average prices in our survey last week. Maliha, thank you so much, and Omar and Ian for joining us on this Monday morning, and have a good week ahead. Thanks so much, everyone.
Thank you.
Thanks.
Bye. Bye-bye.
Bye-bye.